Hello everybody. Thank you for joining me today on our webinar. Today's topic is going to be part 2 of our financial resolution handbook. Today we're going to be covering everything you need to know about installment agreements and currently non-collectible status. But before we get into the content, I just want to tell you a little bit about myself. My name is Vinar AR. I'm the founder of AR Law. What we do here is we help people who have problems with the IRS or state tax agencies. I am an expert at resolving IRS problems, and I know everything about how the IRS works inside and out. It's important to remember that you guys can always use me as a free resource for you in your practice. I'm always happy to answer questions from fellow professionals, and I even have a hotline set up for just that. If you ever have any questions, not just about today's content, but about anything related to what you need to do to help your client solve one of their problems with the IRS, call me. My phone number is 248-350-4000. I really mean it. I'm happy to help, and there's never any charge for questions. So our next webinar is going to be all about financial resolutions, part 2. These are the different options for resolving your client's past due taxes based on their financial ability to pay. We're going to cover installment agreements and currently non-collectible. As you remember, part 1 was about offers and compromise. There are 3 main different financial-based resolutions: offer and compromise, installment agreement, currently non-collectible status. So we are going to talk about the second and the third one. So our presentation today is going to be broken down into 3 separate parts. First, we're going to go over installment agreements in general. And we're going to do a detailed review of the 3 types of installment agreements. And then we're going to talk about procedural rules related to installment agreements. Sorry, that's not on the slide. And then at the end, we're going to go over currently non-collectible status, which is very similar to installment agreements, but a different resolution. So, installment agreements in general. What is an installment agreement? It's an arrangement by which the IRS allows a taxpayer to pay their taxes over time. The key word to remember here is allows. These are discretionary. Very few times will you actually be entitled to an installment agreement. The IRS has the option to demand full payment if you're able to pay. Taxpayers are always encouraged to pay full pay to keep costs down, to minimize interest, penalties, user fees, so on and so forth. I always tell my clients that getting on an installment agreement is the equivalent to roughly a 10% interest rate loan, because there's a failure to pay penalty that continues to accrue, and there's interest, and when you add those 2 together, you add about maybe 7 or 8% loan. So I usually tell my clients, if they wouldn't borrow the money at 8%, then they shouldn't get on an installment agreement either. If you have the money, it's always best to full pay. Generally speaking, if you propose an installment agreement and it's pending, no levy can be issued while the installment is pending, or 30 days after they reject your installment agreement proposal, or while you're in appeals, or while an installment agreement is in effect, or for 30 days after they terminate an installment agreement. There can be no levies. So installment agreements are very effective tools for taxpayers who are in active collections and you need to stop a levy. Proposing an installment agreement is usually a good way to do it. Now, there are different kinds of agreements. There's a full pay installment agreement. What that means is when the taxpayer will pay off their entire balance within the life of the statute. When you're doing a full pay installment agreement, the IRS has a little more leeway as far as what they can accept as the payments. Or there's something called a partial pay installment agreement. Now, anybody who's unable to afford to pay can always request an installment agreement for an amount they can afford. Sometimes the amount you pay every month is not enough to ever pay the balance off. The most extreme example I can think of is my client who owed $13 million to the IRS. We got him on a payment for $25 a month. That is called a partial pay installment agreement, because he can pay that forever and the IRS will never get paid in full. It is kind of like a settlement without actually having to do a settlement as a de facto. Now, when you're doing a partial pay, they're more aggressive about trying to squeeze you for every penny you can afford, and there's a requirement that at least every 2 years they have to revisit the situation and see if they can get more. They're allowed to let you pay whatever you can afford. Now, remember, what makes it a full pay or partial pay is whether or not they're going to get paid before the expiration of the collection statute expiration date. Now, what that refers to is the expiration on the debt itself. The IRS only has so much money during which, so much time that they're allowed to collect a debt. The length of time is generally 10 years from the date of the assessment. Usually when you file the return or the IRS files for you or an audit, a 10-year clock starts ticking. Now there's a lot of different things that can extend the 10 years, so that's a very general rule when I say 10 years. But every tax assessment has a CSED, and when the CSED expires, then the government can no longer continue any collection efforts. They will forgive the debt. If you absolutely insist on paying, they will remind you that your payments are purely voluntary and you don't have to pay. And if you still pay, joke's on you. But once the CSED's expired, they can no longer collect. So they can no longer take installment payments on the debt. You can make voluntary payments, but they won't set up an installment agreement with recurring payments due after the debt's expired. They more or less just write it off. Most of the times. Again, we talk in general rules. There's exceptions to every rule. Before the debt expires, the IRS can just sue the taxpayer and get a judgment, and that in effect gives them 20 years additional. That's beyond the scope of what we're talking about today. The general rule is after 10 years, the debt expires, and you don't have to get on a full pay installment. Just because you're on an installment agreement doesn't mean you're going to pay it all. So now, in order to be able to actually get on an installment agreement, there's 4 requirements that must be met. First is you have to be in compliance with all your filing requirements. You can't have any unfiled returns, which are required. You can't be in bankruptcy. If you're a business taxpayer that has a history of pyramiding or repeating the debts, then you have to be current on your federal tax deposit requirements. That means for the current quarter, your payroll taxes have to be up to date. And then the 4th requirement is your request for the installment agreement must not be made solely to delay collections. Remember, because an installment agreement is a very powerful tool for stopping collections. Remember, they can't issue a levy once you propose an installment agreement, and for a long time after, if you choose to go to appeals, it is tempting to want to do one just to hold the IRS back. But if they determine that your request was frivolous and it was made solely to delay collections, then they will just send it back and they won't process it. So some examples of scenarios that can be determined as solely to delay collections is if the taxpayer repeatedly defaults and requests a new installment agreement without any change in circumstances. Just defaulting once is not a big deal. Everybody misses, everybody deserves a second chance. If you set up a payment plan and you miss a couple payments, they default you and you call back and you want to get back on the payment plan, they won't say that's not solely to delay collections. But if you repeatedly set up a payment plan, don't make any payments, default, set it up again, don't make any payments, default, then the 3rd time or the 4th time you do that, they're going to start to stop and think and say, you know what, we're not processing your request. This is just an attempt to delay collections. This has to be an extraordinary circumstance. These rejections are not often made based on delay collections. It would be a rare case. Or, for example, if you request an installment agreement, it gets rejected, you go through appeals, you lose, and then you just request the same installment agreement again without any change in circumstances. Well, that would be an attempt to delay collections. Or if your request is just unreasonable and does not reflect your true ability to pay. Or a nominal amount was requested and no financial information was provided to support the request. Now, just having a low payment relative to the debt is not enough to be unreasonable. Remember, my guy was paying $25 on $13 million. Well, that was because his financial information supported the request. It was not unreasonable in light of his circumstances. That was all he can afford at the time. The guy was an ex-con, living on mediocre income and, so on and so forth. So just because you're paying a little, I've had, payment plans for $1 or $2 a month, that's not unreasonable in and of itself. If it's warranted by your financials, then that's okay. But if it's unreasonable and relative to your financials, then it's not okay. So that brings us to our first polling question. So welcome back, everybody. Hopefully you all got your answers in on time for the polling question. You all got the right response. Moving on with the content. Next, we're going to go over the different types of installment agreements. Not all payment plans are the same, and there's different variations and different types of installment agreements. The first type is called the guaranteed installment agreement. Now, this is the only time a taxpayer has a guaranteed right to an installment agreement, is they have to meet these qualifications. They have to owe less than $10,000 or $10,000 or less. That excludes penalties and interest. This is just the tax balance. They must not have failed to file timely or pay on time for the last 5 years. So we're talking about old debts. They must have an inability to pay immediately. However, this requirement is usually waived as a matter of policy. Even if they can pay, they'll probably still grant your installment agreement. And your installment agreement must propose to full pay the tax within 3 years. Doesn't matter if you could pay more. Okay? And then you have to agree to continue to comply with the other tax laws. Those are guaranteed installment agreements. Those are the only types of installment agreements that you have a right to. The rest are as a matter of discretion by the IRS, where if you can full pay, you have to full pay. Or they have a right to deny it. You can still ask for an installment agreement. You might get it, but they have a right to deny it if you can full pay. Not with a guaranteed installment agreement, at least not as of a matter of policy. Now, the second type of installment agreement is called a streamlined installment agreement. Okay, with a streamlined installment agreement, this is for taxpayers who have an assessed balance, including the assessed penalties and interest, of $50,000 or less. Now, what I mean by assessed, I mean balances that have posted to the taxpayer's account. The way penalties and interest work is that they'll accrue for a period of time, and then they'll post periodically. So every 3 months or 6 months, or sometimes 2 years will go without them posting the interest. And they'll just continue to accrue, and whenever they decide to post it, they post it to the balance. So when we're looking at streamline criteria, we're looking at the assessed balance, including the posted tax, penalties, and interest. The only thing it does not include is the accrued penalties and interest. Now, streamlined installment agreements must be full pay installment agreement. And there is no collection information statement required. It's not determined based on your ability to pay. It's just determined based on your offering to full pay the debt within the statute. You can get a streamlined installment agreement. The amount of the payment is determined by taking the unpaid balance and divide it by 72 months. They let you pay off your taxes over 6 years. However, if your collection statute expires before then, they might require you to pay more. You have up to 6 years to pay it back, but the payment has to be sufficient to cover the debt before the CSED expires. Now, generally speaking, when you go into a streamlined installment agreement, they will not file a lien against you. Revenue officers, which are local IRS agents, they have a right to make an exception to this rule. Personally, I've never seen it. Every time I've ever gotten somebody on a streamlined installment agreement, they have not had a lien filed, although theoretically it is possible. Now, that is not to say that the IRS will necessarily remove a lien if it has already been filed. If a lien has already been filed and you want it removed, simply getting into a streamlined installment agreement won't do the trick. There are other guidelines and other reasons why the IRS might remove a lien. One of them is very similar to streamlined installment agreements. It applies to it's basically if you get a payment plan based on the old streamline rules. Previously, before they changed the rules related to streamline, there used to be a maximum amount due of $25,000. If you owe less than $25,000, you can get a streamline payment. It wasn't $50,000. And back when it was $25,000, they gave you 60 months to pay them back. It wasn't 72. So what happened was they doubled the amount. They went from $25,000 to $50,000. And then they also added an extra year to pay. Now, so if you fit under the previous streamline guidelines, let's say you owe less than $25,000, you get on a 5-year payment plan, and the IRS has already filed the lien, then there's a provision that will allow them to remove the lien after you've made your first 3 payments. You just have to ask. But if you owe more than $25,000 and they've already filed a lien, getting on a streamlined payment plan will not help you get rid of that lien. That's only for people with less than $25,000. Also, if you owe more than $25,000 but less than $50,000 and you want a streamlined payment plan, the IRS will require the payment method to be a direct debit or a payroll deduction. They don't wait for you to make the payments. To get the expanded or the increased streamlined rules, you have to agree to just let them pull the money out of the account or out of your paycheck every week. If you've previously defaulted on a payment plan, they will require you to do a collection information statement. However, the purpose of the collection information statement is not for you to have to pay the maximum amount you can afford. It's because they want to make sure that you can afford the payment that you're promising. Because if you've previously defaulted and they have reason to think that you can't afford what you propose, then they can reject it as not viable. Now, remember, with the streamlined payment plan, it's just that it says the unpaid balance has to be paid off in 72 months. It doesn't say anywhere that they have to be 72 equal payments. You can get creative, and we'll talk about this more later, with variable payment plans or step installment agreements, or if your taxpayer can't afford to make the 72-month payment, you can offer less. You can say, the 72 months, let's say it's $800 a month is what it works out to. You can say, we'll give you $400 a month for 3 years, and then we'll give you $1,200 a month for 3 more years, and then that'll average out to $800. That is a valid request. That fits the streamlined criteria. There's no rule that says it has to be $800 every single month. You can do $400 for the first half and $1,200 after, as long as it will pay it off. So there is opportunity to get creative, and then of course if your taxpayer 3 years down the road they can't afford the increase, you can always call back and try to renegotiate with the IRS based on what they can afford. So step payment plans are a very creative way to defer the problem and to wait and see, because they might be collectible now, they might not be collectible 3 or 4 years from now. So you offer a step payment plan with a low payment now, a high payment later, and if you can manage to get it accepted, then they might never have to make the high payment. They might just be able to call back and just renegotiate. Now, just like how they doubled the guidelines previously from $25,000 was the original streamline, then they went up to $50,000 a few years ago, and a couple years back they doubled it again. Now you can do a streamlined expanded installment agreement for anybody who owes up to $100,000 in assessed balance. Again, this is a full pay installment agreement, and you don't have to provide financials. You just have to fit within the guidelines, and they added an extra year to pay. If you owe up to $50,000, it's 72 months. If you owe up to over $50,000 but less than $100,000, you get 84 months. Now, one exception is a revenue officer, if you're dealing with one, can require a collection information statement if you are in this expanded guidelines. They have a right to require it, but if you're dealing with automated collections, they will not. The other difference between a regular streamline and an expanded streamline is with the expanded streamline, a lien determination will be made. That usually means they will file a lien. They might determine not to file a lien, but in all my experience, they filed a lien every time I've done one of these payment plans, unless I negotiated around that ahead of time. The other type of installment agreement, streamlined type installment agreement, is called an in-business trust fund express installment agreement. Whereas the streamlined payment plans are for individuals, this is for business taxpayers who owe $25,000 or less in payroll taxes. If you owe more than $25,000, you can offer to pay it down under the balance to fit within these guidelines. If you want a in-business trust fund express IA, they'll give you up to 30 days to make the payment. So if you owe $30,000, you say, hey, look, I'll pay you $5,000, and then we'll set up the payment plan. That's okay. You must be in filing compliance, and you only get 2 years to pay them back. So you got to pay roughly $1,000 a month if you owe $25,000. And if you owe more than $10,000, it has to be a direct debit installment agreement. Just like before with individuals and the $25,000 cutoff, if you're more than $10,000 and it's payroll taxes, they have to pull the payment right out of your account every month. They're not waiting for you to mail a check. Managers have to approve these, and a notice of federal tax lien determination is not required. They don't have to even think about filing a lien, but they can file a lien if they want to. The fourth and final type of streamlined payment, or fifth type, I guess now, it's called an in-business non-trust fund express installment agreement. This is very similar to the in-business trust fund express, but it's for non-payroll taxes or non-trust fund taxes. If you owe corporate income tax, or if you owe employer share payroll tax, or if you owe some excise tax or some penalty, these are trust fund taxes referred to when you are handling somebody else's tax money. When you're an employer and you take money out of somebody's check, that money is held in a trust fund for the benefit of the government. That's not your money. It belongs to the IRS. You took it from somebody's pay. You have to give it to the IRS. That portion of the payroll tax is called a trust fund portion. So if you have non-trust fund balances up to $25,000, they'll give you 72 months to pay instead of 24 months. Everything else is the same as in business trust fund express IA. $25,000 cap, must be in filing compliance, and so on and so forth. Now, for everybody else who either don't qualify for a guaranteed or streamlined payment plan, or they might qualify for a guaranteed or streamlined payment plan, but they don't want a streamlined payment plan because they can't afford the payments. Just because you qualify for a streamlined payment plan to pay over 6 years, what if you can't afford to pay over 6 years? Well, or what if you owe more than $100,000? Well, then you do a non-streamlined or a regular installment agreement. There are no minimum or maximum dollar amounts for the amount of the balance in order to get a non-streamlined/regular IA. You can do it for somebody who owes, $100 or $100 million. Everybody has a right to ask for a regular installment agreement. With a regular installment agreement, payments are based entirely on your ability to pay. There's no year cutoff. It's not relative to your balance. It's what do you got? That's how much you have to pay. You have to fill out a collection information statement or a 433 form. If you're an individual and you're dealing with automated collections, you're going to use a 433F form, which is a short form financial statement. If you're dealing with a revenue officer, you're going to use a 433A form, which is a long form. With a 433F, you don't have to prove anything. You don't have to send any paperwork. With a 433A, everything has to be fully substantiated. The purpose of a 433 form is to list all of your assets and then list your monthly income and your monthly expenses. If you have equity in assets, before they grant your installment agreement request, they can and have told people that they have to sell your assets first. If you have a bunch of equity in the house, it's common for them to ask you to apply for a mortgage before they'll grant the payment plan. And only if your mortgage is denied will they give you the installment agreement. They will look to collect from your assets first, and to the extent that you can't pay from your assets, then they will look at your monthly income and your monthly expenses to determine your ability to pay. Now remember, the amount is entirely determined based on your ability to pay. So it could be a full pay installment agreement or it could be a partial pay installment agreement. A partial pay, of course, is when you're paying a low amount relative to the balance due and the expiration date. You're never going to get it paid off. Now, with a partial pay, like I mentioned earlier, if you get on that, at least every 2 years, they're required to kick you off and make you do it again. The purpose of that is so that they can continue to revisit your financial status. Because remember, with a partial pay, they're never going to get paid back because you can't afford to pay. So with that, brings us to our next polling question. Welcome back, everybody. Moving along with the content, we're going to talk now about procedural rules and other miscellaneous rules concerning installment agreements. First, we're going to talk about how to request an installment agreement. There are many ways to do it. You can do it verbally or in writing or by email or fax, by letter. But in order for a request to be valid, it must have sufficient information to identify the taxpayer, identify the tax liability to be covered, and propose a specific monthly amount or other, periodic payment. It could be bi-monthly or every week or however you want. Any communication that meets those three requirements will be treated as a request for an installment agreement. Remember, the significance of that is the IRS has to put a collection hold on your account while your installment agreement is pending. After a request is made, the IRS has to either approve the proposal immediately or put your account in pending IA status within 24 hours. This prevents any levy actions and stops collections like we talked about earlier. Once you are in pending IA status or your IA is approved or 30 days after it's rejected, there's a long period of time from when you propose an installment agreement that the IRS cannot legally enforce collections or levy or seize any property. So it's very important that when you make a request, if you meet those three requirements, it has to be processed, even if you're not in compliance with your estimated tax payments. A lot of people mistakenly think that, like with an offer in compromise, they won't process it if you're not in compliance with your ES payments. That is not the case with an IA. Now, once you make a request, if you meet the minimum requirements, then the account is placed in pending IA status, even if you don't provide financial info. Just because the request is processable doesn't mean that it is sufficient to accept. Sometimes you need financial information, but that's not required to make a valid request. It might be required for them to accept your proposal, but with or without the financial info, you'll be placed in pending IA status. Then a recommendation is made to accept or reject. It's sent to a manager review, forwarded for processing, and if they recommend rejection, they will send the file to independent administrative review to a separate department at the IRS that will overlook and take a second look at installment agreement requests to see what they think. If they think it should be accepted, they will order that it be accepted. If they concur in the rejection, then a final determination is made. Taxpayer gets a rejection letter, and then that triggers the right to file an appeal. So that is the process, start to finish. They're not supposed to communicate their intent to reject an offer or to propose rejection until after independent review has looked at it. So you'll send it in, and then takes a long time sometimes to get a rejection letter. There is a fee for getting an installment agreement. It's not free. There are user fees. If you're doing a direct debit installment agreement, it costs $31. They take that out of your first payment. If you set it up online, $107 if you do it by phone or by mail. And they waive the user fee if you're low income. If you're non-direct debit, you want to make your payments by check, then it's a $149 fee to make the request online, $225 if you do it over the phone or by mail, or if you're low income, it's reduced to $43 for a non-direct debit installment agreement. So this is what an installment agreement looks like. This is the actual form of the agreement. If you make a proposal, I like to do them on the 433D form. That's what we're looking at. So when I want to propose an installment agreement, I'll fill out the 433D with all the terms, but you don't have to. You can just write a letter, or you can do it verbally, as long as you meet those three requirements. And then once you agree, if it's a direct debit, they will always put it in writing because direct debits have to be signed. They'll send you back a 433D. You fill in the banking information, have your client sign it. If it's not a direct debit installment agreement, it does not have to be in writing or signed. They can just process the installment agreement and you get a request, and then you just make the payments every month. Now, these are the different reasons why the IRS might reject an installment agreement. One is, like I mentioned earlier, if you can full pay the balance. They oftentimes will grant an installment agreement if you can full pay anyway, but oftentimes they won't. They'll just say no. I've had a taxpayer that they had enough money in their bank account to pay, they just didn't want to. We tried to get an installment agreement. The revenue officer said no. We went to appeals and we lost. You don't have a right to an installment agreement. If you have the money to pay, they can just insist that you pay. And if you don't pay, they'll just take the money from you. Okay. Or they'll reject it if they determine that you can pay more than you propose, unless the 6-year rule or 1-year rule are met and additional expenses are accepted. We'll talk about those next. Also, if you pay to make a voluntary lump sum payment as processed, as promised, remember if you're like outside the streamline criteria and you say, well, I owe $110,000, I don't qualify for streamline. How about if I give you $10,000 in the next 30 days, and then you don't give them $10,000? and they can reject your installment agreement because you didn't, meet the terms. Although they should not do that if there's exceptional circumstances why you can come up with the money. They can reject the installment agreement for failure to provide financial info and or substantiation. Remember, the financial info is not required for a request to be valid, but it could be required for them to accept the offer, and it could be a valid reason for them to reject it. The significance of a rejection is it gives you a right to appeal. As long as it's processable and it's processed, they can reject it, you can appeal. They can also reject it for failure to make estimated payments, although that is not applicable to guaranteed or streamlined installment agreements. You have to be current on your estimates. They won't return, if they reject your installment agreement for reasons of not being current, there is an appeal right. It's not like with an offer and compromise. With an offer and compromise, in order to process the offer, you have to be current on your ES payments. Otherwise, they just return it. With an IA, they will process the offer even if you're not current, and they will reject it. The difference between a return and a reject is a reject has an appeal right. If you fail to make your federal tax deposit, payroll tax, or if you do not meet or is unwilling to meet any other conditions of the installment agreement. So we mentioned this just a minute ago. There is something called the 6-year rule, and there's also called the 1-year rule. These are important to remember. The 6-year rule says, let me preface this. When you do a financial analysis, and when you're doing a standard installment agreement, it's based on how much you can afford to pay. There are certain guidelines. There are certain expenses that the IRS consider reasonable and they allow, certain expenses they don't. There are certain expenses that are limited, like housing and utilities. You can only spend so much depending on your family size and what county you live in. Or like if you have private school tuition, that is not a necessary expense. It doesn't belong on your financials. That is normally, they have these rules as to what's reasonable. You can't have a $10,000 a month house, and owe them money. They just won't allow for it in your budget when you're negotiating the installment agreement. However, under the 6-year rule, if a taxpayer cannot full pay and they're not a streamlined candidate, they can still qualify under the 6-year rule, and all expenses, even above the standard, even what the IRS doesn't consider reasonable, will be allowed in your financials if you show that you can stay current, pay your current taxes, pay your expenses, and still cover the payment plan, and still pay the IRS within 6 years, then they should allow all of your expenses. It doesn't mean everybody has a right to just pay in 6 years. You have to list your expenses and come up with what you can afford to pay, but it means that if you make $1 million a year and you want to put your kids in the best private school in town and you can afford it, and you can still afford to pay your taxes off in 6 years, then God bless you. Put your kids in private school. We'll work out your payment plan. We'll allow for that in your budget. Or if you want to keep living in your $20,000 a month mansion, that's fine too. As long as you can afford it and you can still afford to pay back your taxes, they're supposed to allow the expenses even though they would otherwise be unreasonable. But if you make $1 million a year and you just want to blow the money and you just, you don't really have expenses, you just don't want to pay, that doesn't qualify. You have to have expenses for the 6-year rule to kick in. It's not the same. A lot of people confuse it and they think that the 6-year rule just says that anybody who can afford to pay in 6 years has a right to pay in 6 years. It's not that simple. What it's about is about whether certain expenses will be allowed in your, computations of what you can pay and what you can't pay, or whether those expenses will not be included. And the 1-year rule is for people who don't fit in the 6-year rule. Let's say you're over the standard on your housing and utilities. You used to make a lot of money, you got a big fancy house, and you lost your job, and the IRS works out your budget and they max your housing expense. They say, oh, you live in a $10,000 a month house, but we're only going to allow $2,000 a month in your budget. Well, now your payment plan is going to be $8,000 a month more than what you can really afford, because I don't care if your housing expense is reasonable or not, you still have to pay it, at least in the short term. So the 1-year rule deals with that, where if your expenses are out of what they consider reasonable, they'll give you 1 year to get them in line. They'll say, okay, fine, we'll allow the $10,000 a month house payment, so your payment plan could be zero for now, but 1 year from now, your payment's going to be $8,000 a month. You have 1 year to figure out your house payment, so that way you're not out on the streets, because, they're it makes sense, right? Because people get into contracts or they get into situations and you can't just ignore the expense. You still have to pay it. So these are kind of like step installment agreements. So there's different ways to pay if you're on an installment agreement. The preferred method is direct debit from your bank account. Your second preferred method is a payroll deduction. You can also have them charge you on your credit card every month, or you can mail in a check or a money order, or you can go online and do it through direct pay, which is a free service by the IRS. Or if you're a business, you can do it through the EFTPS system, where you would go in and just select payment due with IRS notice. Now, the thing about installment agreements is with all non-streamlined installment agreements and expanded streamlined installment agreements, a lien determination will be made, which means somebody will look at the file and decide if they should file a lien or not. Now, the lien can be filed when the installment agreement is pending, at the time they grant the installment agreement, when they reject it, during the default, while your payment plan is in effect, during appeals, really any time. There's nothing about an installment agreement other than the streamlined rules and the rules we talked about that prevent a lien. If you don't fit in any of those guidelines, then you can pretty much count on a lien being filed. Now there are, like I said earlier, there's no rule that says your installment agreement has to have consistent payment amount throughout. The payments can be increased or decreased at predetermined dates. They call them step installment agreements. In fact, on the 433D form, there's even a spot to list the increases and the decreases, the steps ups and the step down. To request an installment agreement like that, the increase or decrease just needs to be supported by the facts. You can't just request them arbitrarily because you want to, but if there's an anticipated reduction in income or expenses, if you have seasonal income and it goes up and down, or if you have projected receipt of an inheritance or something, you can work that into the installment agreement. And you can, like I said earlier, use the step installment agreement as a creative way to fit within streamlined criteria, even though your taxpayer otherwise can't afford a streamlined installment agreement. Now, the IRS can terminate an installment agreement if you post a new balance, if you fail to file a required return, or you miss a payment. It can be terminated. It also can be terminated for none of those reasons, especially if it's a partial pay installment agreement. Every 2 years, they'll require you to do financials again, and if they determine you can pay more, they'll terminate your installment agreement and require a new one. They can also be adjusted after the fact, but if they do terminate an installment agreement, you absolutely have a right to appeal. You request a CAP hearing, a collection appeals program. That's done on Form 9423. We talk about that more in our module about how the IRS is operated. So that brings us to our third polling question for today's webinar. So moving along, that's everything I have to say about installment agreements. We're going to spend the next few minutes talking about a closely related topic, which is called currently non-collectible status. So what is currently non-collectible status? Is when the IRS agrees that you just don't have to pay right now. They don't forgive the debt. They just kind of put you in the back burner. The most common grounds to be placed in currently non-collectible status is if you can establish that collecting the liability will create a hardship, leaving the taxpayer unable to meet their basic living expenses. Basically what that means is that if you can establish that you can't afford to make any monthly payment, then you can get CNC. It's just like my guy who's on the $25 a month payment plan. You can easily, if you can't even afford $25 a month, based on the way the IRS looks at your financials, then you can also request currently non-collectible, which is essentially the same, functionally the same as the partial pay installment agreement, except you just don't have to make a monthly payment. It's also possible for businesses, but in order to get currently non-collectible for business, you have to show them that you're viable, that the business can stay current and stay afloat, but that it cannot make installment payments towards the past due balance. Taxpayers can also be placed on non-collectible status for non-financial reason. Remember, the most common reason is because of a financial hardship, but also there's an inability to locate, there's an account below the tolerance level, there's a certain threshold that the IRS won't tell anybody what it is, but there's a certain threshold they just don't even bother with, or if they put you as inability to contact. So unable to locate, unable to contact is if The IRS can't find the taxpayer or their assets. They'll just put the account on the back burner, put it in unable to locate currently non-collectible status. Okay. It's not used for taxpayers outside the U.S. If you're outside the U.S. and they know what country you're in, they'll send you to their international department. This is used where they literally just don't know where you are. They'll go to your last known address and it's vacant, or somebody else lives there who doesn't know you. There are a certain amount of checks that they have to make before they can close the case, and the amount of work they have to do trying to find you depends on how much you owe. The more you owe, the more extensive the search is conducted. For example, they can check your passport to see if you come and go from the country, to check your credit report, or they might not do anything. Maybe they'll just make a minimum attempt, send a few letters, and just put you on unable to locate. It really depends how much you owe, but nobody really knows what the cutoffs are. That section of the guidance is redacted. It's not publicly available, of course, because then people would game the system. Now, the difference between an economic hardship non-collectible and an unable to locate non-collectible, the biggest difference is that the unable to locate non-collectible are still subject to the passport restrictions in the PATH Act. If a taxpayer is seriously delinquent on their tax debt, then the State Department is not allowed to grant you a passport under the PATH Act. So, however, if you're seriously delinquent and you're on economic hardship CNC, then they can't deny your passport. But if you're seriously delinquent and you're on UTL CNC status, then they still will deny your passport. So a hardship exists if a taxpayer is unable to pay the basic living expenses. Okay, the basis for the hardship is based on the collection information statement. It usually involves taxpayers with no assets and little income. And sometimes you can do it without financials. If low balances and you meet one of these requirements, terminal illness, excessive medical bills, if you're incarcerated, if your only source of income is Social Security, welfare, unemployment, or if you're unemployed with no source of income at all. If you just tell the IRS about those facts and you have a low balance, they won't make you do a 433. But for everybody else who wants to establish a hardship, you have to do it with a 433 form. Again, a 433F if you're dealing with automated collections, and you don't need any proof. Remember, automated collections is easy. You call them, you go over the numbers over the phone. If everything sounds good to them, they won't ask you for any documentation. If you're dealing with a revenue officer, you do a 433A, but you have to prove every number. If you're in business, you can still qualify for CNC, but you would use a 433B form, which is a business collection information, and you must stay current with your filing and payment requirements and demonstrate the ability to remain current. If the IRS doesn't think you can stay current, they will just shut your business down. They have no reason to let you continue in business if you're going to continue to not pay payroll taxes. It really only applies to payroll taxes. And if you're in business non-collectible, there's a mandatory follow-up 18 to 24 months later. The advantages of currently non-collectible is it stops collections, and it can be used to ride out the life of the statute until the CSETs expire and the IRS forgives the debt. Disadvantages is that they'll take your tax refund every year. You have to provide full financials and documentation. You have to prove that you can't borrow against your assets. They'll continue to accrue interest and penalties. The balance doesn't go away. You still owe the money. Currently non-collectible has the word currently in it for a reason. And then there's a mandatory review every 24 months. So the debt doesn't go away until the CSET expires. If you're in CNC, it's different than an offer in compromise. They'll just put you on the back burner, but you bet within 2 years they're going to make you do it again. So sometimes people, they pay to get put in CNC and they're repeat clients. They got to come back every 18 to 24 months to do it over again. So thank you all for joining my webinar today. I hope you found the content very informative. Any feedback you can give us on your review forms would be greatly appreciated. I'm always looking for ways to make my content better. And please don't forget, one thing I want you to remember is you guys have me to use as a free resource to you in your practice anytime you need. If you have any questions about today's content or about anything else related to solving IRS problems, you have a client who's in a jam, you're not sure what to do to get them out of it, I'm just a phone call away. The phone number on your screen is a designated hotline just for professionals to ask us tax questions. Please don't be too shy to use it, or you can email me at the address on your screen. Thank you again for your time, and have a wonderful day.